And I'm going to posit something to you, Matt. I was thinking about it this morning. The New England Patriots and this stock market seem very similar. They've been good for a long time, but they're starting to show some cracks. The doubters are out in force, and they're making some uncharacteristic mistakes. However, the Patriots have always surprised to the upside. Do you think this market, like your beloved Pats, will eventually come through and rally, or is it truly the end of an era?
I tell you, you're absolutely right. The Pats, especially that loss to the Miami Dolphins in the last second, was a tough one. I think the only worst loss this year was Virginia Tech when they lost to Appalachian State. But we won't go on into that. But to answer your question, absolutely. I actually, I've been negative on the market right through pretty much most of this decline here. But I think we're setting up for a pop. I'm also concerned about what's going to happen next year. I think we could see a lower low for a variety of different reasons. However, I think we're setting up for a sharp rally. I think the Fed is going to be a catalyst for that. And I think it's going to begin, whether the lows were reached yesterday at the close or today at some point, I think it's going to be a sharp one. It's going to rally 6 to 8%. It's just we're starting to see, even though we haven't had that huge washout, we're kind of seeing the semi-extremes in sentiment and in oversold conditions.
Okay, let's talk about the Fed then. So you said the Fed could be the catalyst. Do you expect a rate hike tomorrow? Number one.
Yes, I do. I think, it's kind of funny because we're starting to hear more and more about this dovish rate hike. I do think they'll have a rate hike. That's baked in. Everybody knows it. It's well telegraphed. And the Fed, if they were going to change on that, I think they would have telegraphed it in advance. Now, the thing is, though, is that even though people are talking about maybe a dovish rate hike, in other words, where they talk about maybe not raising rates as much next year, as many times as they have been saying, or even talking about their QT program and how much they're going to shrink their balance sheet. But the point is, even though people are talking about it, it is certainly not priced in with the big sell-off we've seen over the last couple of weeks and obviously what we saw yesterday. So I think that it's not priced in, and that's going to be something that could give the market a nice sharp bounce.
Are we starting?
Let's face it, the market does tend to rally around that.
Okay, yeah, but are we starting to know? Don't worry about it. By the way, it was Old Dominion, not Appalachian State. Are we starting to realize how important? I got your point. Well played. Are we starting to realize just how important the Fed's balance sheet reduction really is? I mean, Jeff Gundlach made the argument yesterday that maybe many of the gains we'd seen in the equity market recently was almost entirely tied to the Federal Reserve's sort of easy money program. And now that the balance sheet is being delevered, we're seeing that exact same amount of money be shrunk off.
I definitely agree with that. I mean, just look at, the stock market had gotten well ahead of the fundamentals. And all you have to do is look at the earnings growth from 2011 to 2016. It averaged, for the S&P 500, only averaged about 3% per year. And yet the stock market almost doubled over that time. That wouldn't justify that kind of rise. But I think it was because of the liquidity that was provided into the markets through lower interest rates and, as you mentioned, the huge, massive rise in its balance sheet. Now that liquidity is being taken away and interest rates are being normalized back up, that means that asset prices, including stocks, have to be normalized back down. So even though I'm looking for a nice sharp rally of 6 to 8% going into the end of the year, I think that's going to be a good opportunity to sell. And like Jeff Gundlach said about yesterday, I think we will see lower lows next year.
Oh, that's interesting because we had, I don't know if you're probably coming into the studio, I get it. We had Sven Henrik, who's another chartist on from London. He's a little more worried long term, but like you, Matt, in the short term, he believes this market could pop. What are you seeing that suggests that 6 to 8% end-of-year rally? Is it all technicals?
Pretty much, to be honest with you. But you see sentiment. We saw, the AAII report that came out last week, and it was at the lowest level since 2013. We're also seeing, you saw the put-call ratio yesterday got up to above 1.5. That's usually a level that signals at least a short-term gain. We saw a rise in the VIX. It's still not, I think, as Jeff Gundlach said yesterday, I'd like to see it above 40 before you get the washout. But you also had breadth yesterday in the S&P 500. The advanced decline was 12 to 1 negative, not the huge extremes that we see at the absolute bottom of the market, but it's usually the kind of that you see at a short-term bottom. So, and it's exactly what we saw. It was interesting too that even though the volume yesterday wasn't huge, it was big for a Monday. And the only other day this year that we've had volume that big, October 29th, which was the beginning of an 8% rally that we saw at the very beginning of November.